What if there is no premium when you are selling put options? Ladies, gentlemen, all the proper pronouns. This is a real concern. In the stock market right now, I'm having some difficult time getting good amounts of premium on companies I'm selling put options on. My name is Brent. Welcome to the I Have Success YouTube channel or website, whatever you're looking at. You see it right here. We got free stuff. We got paid stuff. But I'll tell you what, all this stuff is about selling cash secured put options on stocks you'd be happy to own. There is going to be a link popping up right here at the 1 minute mark of this video. I suggest when this video is done, you watch this link that's going to be popping up right about now, right there at the 1 minute mark. Easy to remember. You don't have to watch it right now. But my friend, that video talks about the unfair advantages of selling cash secured put options on stocks you'd be happy to own. Hey, you know what? It might be a little bit out of your mental comfort zone. You're going to have to learn a little bit about an income statement, balance sheet, your financial statement, and see how the cash and the assets flow through when you're doing the strategy. But believe me, it's 100% worth it when you have this under your belt. So let's look at my paper trading account. Right? It is paper trading right here. I have to address this very, very clearly. And this is the #1 comment that people over the last year have left on this YouTube channel has been about paper trading. Basically, they're saying, oh, you're just paper trading, blah, 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 all this stuff. So, I've said it on other videos. Maybe I'll just have to say it on every video. Paper trading is a good thing. The reason why it's a good thing is similar to why sparring is a good thing if you're going to do some kind of competitive fighting. Paper trading is a good thing, just like simulated aircraft flying is a good thing when you're learning how to be a pilot. Paper trading is a good thing, just like simulated firefighting is a good thing when you're learning how to be a firefighter. You want me to keep going down the list of all these different activities that are in the world of human beings that have some simulated training to them that allows you to be better prepared to handle the risk of the task? Now, it's pretty easy to understand with those other things because that's physical risk. But for some reason, people take the blinders off the horse and they strap them over their own eyeballs when it comes to the stock market. The stock market's not any different. You're dealing with risk. In fact, maybe it's even riskier because it's risk you can't see and you'll be blinded by the greed. You think you're going to get rich in just 2 trades. That's what happens with most people. They're blinded by the greed. They think they're quitting their job and retiring and becoming the next Ray Dalio in 20 minutes of trading. Well, I'll tell you what, my friend, when you step into the ring, you see who you're against. But when you step into the market, you don't. You don't know who you're up against. On the other side of your trade, there's somebody else. So the point is, yes, this is a simulated trading account. There it is. You should be using one too. If you're a beginner, you should be using one too. Man, I almost feel like, why am I wasting my time lecturing on this paper trading? You know why? Because so many people think it's a dumb thing to do. If you think it's a dumb thing to do, then you're gonna basically say that the way that you're gonna learn to fly the helicopter is you're jumping in the real helicopter the first time and you're just hitting the buttons and going for it. Good luck to you. I ain't riding with you. You're not gonna be my partner. Anyways, let's get on with it. All right, it's a paper trading account. Selling put options. What is it? I got a put option right here. Oh, I got to tell you this too. This is not financial advice. This is not, hey, you go out and use this ticker symbol. I'm using ticker symbols that I don't recommend, so you can't misconstrue these with the stocks I'm actually using. Right? I'm just looking through I'm looking through like these 12 different ETFs, and we're just kind of picking and choosing off these 12 ETFs. These are not suitable for you. They're not suitable for me. They're only suitable for education and training. So you want to learn how to pick stocks that are suitable to you? Well, this playlist right here would help. And these downloads would help. They're not necessarily the be-all, end-all, but they would help. And ultimately, got to have some responsibility, that type of thing. But I guess I'm trying to cover my legal bases here. So this is just educational information. Take it for what it's worth. But right now on XLU, it's a utility ETF. I had been selling put options on it. I got filled. So what is a put option? Well, let's pull up an option chain. What is an option chain? It's not pulling up. It's one thing that's not pulling up right here. An option chain is this. These are all different options chains, and let's just pull one open here. So the option chain, hey, bonkers. Oh, you know what? Let me put this. Sorry about that. I've been practicing some stuff on the in the futures, so we got to get back here to XLU. Boom. There we go. Come on, XLU. Waiting for data. Or is it waiting for data? Which do you prefer? Potato? Potato? You probably don't care as long as that potato or potato is delivered in a timely manner, which is not. Oh, there it is. It wasn't happening before then. So here's an option chain, right? On one side, you got the calls over here. Oh, let's change this off from butterflies. You know, tell you what, I was experimenting a little bit. You know, doing some butterflies in the futures. You know, it's probably something you shouldn't be doing. But you know, what can I say? Sometimes your good buddy Brent. You know, I'm still using these paper trading accounts, right? I'm you know, when I'm upping the level of risk, I'm not doing it with my real account. You know, come on, work with me here. So, anyways, here's your here's an option chain, right? We got strike expiration dates here, which it's the same expiration date, right? Here's when you open it up. Here's all these different dates, and in these parentheses here, we see how many days to expiration. Boom, open this up. Now we're looking at 20 days till expiration. That's normally what I look at, is how many days to expiration. I don't really pay as much attention to the actual date. Looking at there, and you see, right? We got the expiration date down the middle. Here's a strike price. This is the price that the stock could go up and down. Now you see how it's black over here, in the kitty corner it's black over here, and it's kind of this, I don't know what color that is, to be honest with you. Let's call it blue or purple, like whatever. It's this color over here, it's this color over there, right? Their kitty corner. This is called out of the money. This is called in the money. Guess what? This is in the money, right? This color is in the money. So on the call side, in the money is this way. On the put side, in the money is this way. Vice versa. On the call side, out of the money is this way. Out of the money is this way. Now, what does that mean? Out of the money and stuff like that. Well, you might have to do a little digging around. Why don't you watch the why don't you watch this playlist and get some of those terms down? Well, we'll just kind of keep going over them a little bit here. So this is the option chain. Now, put option on this side. I sold a put option on XLU with a $68 strike price, which was right here. And see, back then when I first sold it, the 68 was in the black. And what's happened since I sold it is the stock price went down. And then I got assigned. Well, what does assign mean? I sold the 68 strike price. The stock was trading above 68. So 68 was in the black. The stock price went down. Let's look right like this. 6 months, right? We got 6 months of data. This is a 200-day moving average. 6 months of data. Each one of these red or green things is called a candlestick. That's represent 1 day of trading. So somewhere back here, somewhere in here, I sold the 68 strike, right? And then the stock dropped down below 68. So when I sell a put option at 68, basically, now there's a little more to it than this, but let's keep it basic. Basically, at the end of my expiration date, which is what we talked about right here, how many days till expiration, this particular date. At the end of my expiration date, if the stock is below my strike price when I sell the put option, that means I'm going to buy 100 shares of this stock at that specific strike price. If the stock remained above, let's say if this was, let's say my stock expired on this day, or excuse me, my option expired on this day. Well, it's above 68, so my option would expire worthless. So I would just keep the premium, right? You get paid a premium. This is the side, the bid side. That's what you get paid on. Now, there's a little bit of wiggle room in there, but again, just to kind of keep it simple, you get paid a premium to sell this option, and it would expire worthless. Now, whether it expires worthless or not, if you structure this in a certain way, you can have an unfair advantage when it comes to trading. And that video at the 1 minute mark will kind of help explain that. So I sold that option at the 68 strike. I got assigned because XLU started trading below 68 sometime on my expiration date or before. So I took ownership of 100 shares of XLU. Excuse me, I kept saying it's at 68. I sold that option at 67, right? Trade price right here. My apologies. Please bear with me. And now XLU is trading around 66. So now what I did is I sold a call option. A call option's here on the other side. And it's kind of the reverse. So when you sell the put option, you're basically selling a commitment to purchase the stock if certain things happen. That's on the put side. When you sell a call option, you're basically selling a commitment to sell the stock if certain things happen. So now that I own 100 shares of XLU at 67, I sold a commitment to sell 100 shares at 68. Because I bought it for 67, I'll sell it for 68 if it's above 68 at the expiration date. I took in 14 cents times 100, because 100 shares, 14 cents per share times 100. I took in 14 bucks in order to do that. Some people might say, oh, you only took in 14 bucks? It's a waste of time. Well, sell 25 contracts then. Sell 1 million contracts, whatever. But then you're probably going to say, or someone might say, well, I don't have enough money to cash secure that or something. Well, welcome to reality. Welcome to the real world. Oh, that's just how it is, man. You want to play the stock market? Hey, you're not Ray Dalio. You're not getting special favors. You're not Sam Bankman-Fried. You're not getting special favors. You're not getting hooked up. You're not Gary Gensler's nephew. Me either. So I don't get special favors. So anyways, that's how we do it. We just play with what we got. You know, you learn to work with it and grow your account over time. So what's going on now? So this video is supposed to be about what do you do when there's not much premium? What do you do? A lot of people will become disenfranchised. They will give up on the put option. They will give up on the wheel strategy. They'll say, hey, this selling option stuff is for the birds. Can't make any money doing this. And sometimes what happens, my fine feathered friends, I honestly, actually, I don't know if you guys have feathers or not. Obviously, I'm not able to see who's watching these videos, and I'm not sure if you're a feathery person or you just like what kind of person you are. But when the VIX is low like this, look at this, the VIX hit a new low, volatility index. When the VIX is low like this, generally you're not getting much premium. You're not getting a lot of premium. So for example, let's look at around 30 days. All right, it's 34. I know, but that's around 30 days. All right, got premium way out here. There's some other stocks in my real money account though that I'm not getting good premium for. So a couple things that I'll do. One thing, if I'm not getting good premium, one thing I might do is I might sell more time. A lot of times when we're selling out of the money options, we like to sell up. A lot of people will say to sell like 30 days or less, because once you start getting here 30 days or less, the option, this thing called Theta Decay kicks in, time decay. You can imagine an ice cube. I got a video somewhere on this channel showing how Theta Decay works, and I got this nice little graphic of an ice cube moving closer and closer to a fire and how it melts more and more rapidly. Well, that's what happens, time decay. As you get closer to expiration, if your option is out of the money, it starts losing value more rapidly and rapidly, value due to the time component of that. It's kind of complicated if you're new. You know, there's these different things called the Greeks, and there's like 5 to 6 different things that are components of making up the price, the value of an option. And one is time, right? So if you sell more time, if you're selling the option, you want to bring in money, right? Let's take a look here. Let's look at, to keep things simple, let's look at the $66 strike price on the put. we got a big bid-ask spread here with, let's just look at the bid, right? 63 cents. Now, let's take a gander over here at the end of this year. So instead of 34 days, we're looking at 188 days. Look at this. Same strike price, 66 days. Look at this. You're taking in $2.37 per share, right? So when you multiply that times 100, that's 237 bucks you'd be taking in. But you're selling a lot more time. So that's one opportunity, a different way you could look at it. Now, don't just randomly go with 188 days because you saw me here doing it here. Don't just go with the end of the year, right? You got to be more strategic than that. You have to. There's a bit more to it, right? And that's why, if you're really new to this, that's why you don't use your real money. Use a paper trading account. Learn all these little nuances. Make your mistakes in the pretend world. And you people that are saying paper trader, time waster, we got a big internet finger for you. You can take that and go have a Friday evening dinner with it, because it is Friday here. It's dinner time, and that's how it is, right? Don't risk your real money. Learn, then you can manage your real money. You can manage the risk on your real money. So anyways, that's one thing that you can do. All right, you could sell more time. Now there's other things you got to think about, like if you're selling more time, what strike price do you want to sell? If you're gonna sell the December 15th option here, are you still gonna go with 66? You would probably determine that based on what you think this is gonna do. Because if you sell the December 15th 66 strike price put option on XLU, you're basically saying that that you're willing to buy for the next 188 days. You're willing to buy XLU at $66 a share, no matter if it drops down to 57. But if it goes up to 78, like, no one's going to want you to buy it, right? So maybe you should look at that. Another thing that you can do while you're looking at this is just as a very quick and dirty, not completely accurate, you can look at the delta here. Now, what exactly is delta? There's a little more to it than this, but just for the purpose of selling put options, you can look at delta and you can have a rough idea of how likely it is for this option to expire worthless. This is not exact, and that is not the real, that is not the primary use of delta. It's just sort of like a side function that you can use to have some degree of accuracy. And it's definitely not 100%. I don't know what percent it is, but you can just get a rough idea. So for example, we sell right here, looking at delta, this tells us it's got about a 51% chance of us getting assigned, of this option expiring below $66 upon expiration date. Now if we look over here at the $60 strike price, we got a delta of 23. So that's telling us that this basically has about a 23% chance of this option expiring below $60 at December 15th. And then as we go lower, like for example, let's just look at delta, see how it's dropping. 20% chance, 15% chance, 10% chance. Look at that over here at the $54 strike price. So again, if you go to a cocktail party where it's a bunch of option traders and they say what is delta, and you say delta tells you your probability of expiring in or out of the money, they're probably not going to say yes, that is it. They're probably not. Someone might say, yeah, you could kind of use it like that, but it's not 100% accurate. And delta actually has a different definition. This is sort of just a side note you can do with delta. But if we're selling cash secured put options, hey, it works fairly well for that. So that's one thing that you could do. You play with those in conjunction in your paper trading account. Now, what's another thing that you could do? So that's one thing that I personally do, is I might sell more time. Another thing that I'll do is I'll just whatever strike price that I want to sell the option at, if it's only giving me 5 cents, sometimes I'll just take the 5 cents. Hey, I get it. It's not flashy. It's not exciting. But, you know, either is owning a plumbing business. I'll tell you what, if you look at the financial statement of a lot of plumbing businesses, you're going to be impressed. The financial statement of a plumbing business statistically has a greater chance of being impressive versus a flashy nightclub or restaurant. It's not a 100% thing. You definitely got some longevity with the old plumbing stuff. But so anyways, the point is sometimes in the world of money, sometimes flashy and prestigious isn't necessarily profitable, right? Or sometimes profitable isn't necessarily flashy and prestigious, right? I get it. Everybody wants to get rich quick. Everybody wants to buy Amazon in, 1800s when it was only a penny a share, and nobody wants to sell a put option and make a whopping $5 to $10 on it. So when the VIX is low and there's not a lot of premium, me personally, I don't compromise. When I'm selling cash secured put options on stocks that I would like to own at a price that I'm comfortable paying, that's my priority right there. That keeps me out of trouble. And if that means I take less premium, then you know what? I take less premium. I'm not going to, when I'm doing this strategy, I don't compromise on, for example, I don't start selling put options on stocks I don't want to own. I don't do that with this strategy. I sell cash secured put options on stocks that I want to own at a strike price that I want to buy them at. So if that means, so for example, if I only wanted to pay $60 or less for XLU, then I wouldn't go up here to 61 because I can get some money. I want to go up here to 63 and a half and be like, hey, it's got a 20% chance of doing it. It's not going to happen. I wouldn't do that. I don't do that. I sell on the stock that I want to own at the strike price that I want to buy it at. And if I can't get any premium here, I'm going to look at the next expiration date. $60. Okay, I got some premium here. So I'm going to sell longer in time, because once I sell it, I'm legally obligated to buy it at the strike price. So me personally, I don't compromise. I will only sell cash secured put options on stocks that I want to own at the strike price that I want to buy them at. Now that doesn't mean I don't sell naked options in other places. That's not what it means. It means for this particular strategy, for selling cash secured put options on stocks that I want to own, that's how I do it. And this has been the bread and butter strategy for me since, I don't know, like 2014 or so. I can't remember exactly when. I know that 2014 is when I really started it really dawned on me that selling put options on stocks that I want to own made sense. And so yeah, it's been pretty good to me. It's been really good to me, to be honest with you. It has been the one strategy that I've never lost money on. I've never lost money. That doesn't mean I haven't been underwater for a while, because I might get assigned, and a stock that I own might be below, like this, the price that I bought it at. But through dividend income and selling call options, and just from that alone, I start lowering my cost basis, right? The trade price. Like if you take in $1 through selling options and receiving dividends, your cost basis is not 67 anymore. If you take in $1, it's down to 66. When you take in $2, it's down to 65. When you take in $3, it's down to 64. And then now I have a buddy that's a CPA, and he argues this with me all the time. I don't even, actually doesn't argue with this with me all the time because I don't have this conversation with them anymore. Right? This is not the way that I guess CPAs look at it. This is not the way that you do taxing and stuff like that or whatever. And great, you know, we'll give them the golf clap and all this type of stuff. But rats have tails, and I don't give any rats tails about that. What I care about is that $67 per share flowed out of my account to acquire these stocks. And when I have money flowing back in from trading this income producing asset around through selling calls against it or you know, bringing in dividends, when I start putting money back into my pocket, I look at that as reducing my cost base. And you know, whether or not a bunch of you know, CPAs will agree with that or not is irrelevant to me, because the gas station doesn't argue with my money. When I roll up to the gas station and I take out my TD Ameritrade debit card and I put gas in my car from options that I was selling or dividends that I brought in, they don't debate with it. They just take my money. They take it. And since I got it, you know, in theory, if we're looking at this, since I got that money off from you know, this particular asset, then, you know, I'm looking at reduce my cost basis. So if I bring in, right now it's at 66, if I bring in $3 or $4 and you know, if my cost basis is down to let's say 64 and I sell it at 66, let's say I don't take any money out with a debit card and put some gas in the car. If I don't do that, ultimately when we do all the accounting, I'm going to end up having more money in my account, right? Not a negative. But normally what I do is I just keep cash flowing these. If they're underwater, if this stays at 66 or goes down to, even if it goes down to 50, I'll continue to sell call options on it and I'll continue to collect dividends. There was a time when I bought like 2,300 shares of AUI, which is a delisted, I don't even think AUI is, I think it went private or something. That's why I don't mind telling you, because I don't think you can trade it anymore. Even if you can, don't do it. It's not for you. Right? Something goofy here with AUI. Don't be trading AUI. It just doesn't look the same anymore. Look at this. Barely. It used to be super liquid. Had all these look at this crappy stock to be trading on. I don't even know if you can trade it anymore. So don't be trying this. But AUI, one time I bought about 2,300 shares at $5.50 through selling put options on it. And eventually, like, it was the only stock I was trading at that time. And so I had whatever, you know, I had about $10,000 or so in my account, and I got assigned all those shares. And then AUI went under $5.50. It was under $5.50 for like almost a year and a half. And during that time that it was under $5.50. So on paper it looked like I was losing money, but I was never losing money, because every week or every 2 weeks I was selling call options. I was bringing in some bucks. There was one time I remember I was making around $85, $90 a week from selling call options. And of course I was getting dividends too. So when everything was said and done, eventually AUI ended up, I don't know how high it went, but I remember I sold out of it after about a year and a half later. It started going up again. I sold all those, I sold all those shares for $6 via call options. So I think when everything was said and done, I think I cash flowed somewhere around like $1,500 in a year and a half. Now someone might say, oh, in a year and a half, you could have done a lot better with your money. Yeah, well, if you would have told me when I was young enough, I could have been a politician. I could have been like Nancy Pelosi and really making a lot of money in the stock market. But I didn't. Right? I'm here right now, and I tell you what, I'm happy that I did that. So I guess part of this is, understanding that people, and don't let this happen to yourself. If you start thinking like, Well, I can make a whole lot more money doing something else. Yeah, you could, but at least have the strategy under your belt, right? It's a good strategy to have under your belt. It doesn't have to be your be-all, end-all. It's not my be-all, end-all, but I'll tell you what, it's my go-to all the time. If I ever have to leave my town, I'm making sure I got these put on because it's very low maintenance. If you just have a lifestyle where you can't really be in front of a computer, you're going to love this. This is very, very low maintenance. It's the tortoise, right? You will consistently make money. That's what's nice about it. And you got to know what you're doing, though. I mean, you can't just jump in blindly. This sort of strategy, have you ever heard people say it's simple, but it's not easy? Have you heard people say that? The network marketing people, they say that all the time. It's simple, but it's not easy. You just follow this system. Well, this is the other way around. This is easy, but it's not simple. It's complex. Like, you got to know what a strike price is. You got to know what a call is. You got to know what a put is. You got to know what expiration dates are. You got to know what delta is. You got to know what theta decay is. You got to know all these different things. You have to know what obligation are you taking and all this stuff. Like, yeah, you really have to know how to pick a good asset. How do you pick a good stock? How do you pick a stock that's not going to pull a Coinbase or a what's those other ones that have been tanking? Oh, how about a Nikola? How do you pick one that's not going to pull a Nikola on you, or whatever these fraud stuff, or how do you pick one that's not going to pull a GameStop on you, a Bed Bath and Beyond? You got to be able to navigate some of these things. But once you can navigate these things, it's actually easy. It is much harder to do butterflies than it is to do this. Right? That's why I'm practicing butterflies. Ha ha ha! You got it. Practicing butterflies on the ES, the futures. It's not. It's a gamble, right? But hey, I live in Hawaii. I don't go to the chicken fights. I don't go to Vegas. I don't gamble that way. I try to trade with the odds in my favor. And that is Option Genius guy, Alan. You can check out him too. Anyways, my friends, I hope you had a fantastic time. I really enjoyed hanging out with you for the evening. It has been wonderful. I hope you got something out of this. The biggest things I want you to get out of this is, number one, paper trade. And if people tell you paper trading is a waste of time, don't debate with idiots, right? When you debate with an idiot, that means there's two idiots. So just let there be one idiot. And sometimes these people aren't actually idiots. But when it comes to a person saying that paper trading is a waste of time, they are an idiot in that context of the stock market. Paper trading is not a waste of time. It's a very, very valuable thing. Make rookie mistakes in a simulated trading before you risk your real money. The other thing is, if we're in a low kind of premium environment like we are now with the the VIX being real low, put option premium is low, you can look at selling more time, right? Selling further in time to make a little more money, or you can just be happy with the low amount of premium, and at least you're bringing some money in. But do not compromise. Stick to it, right? If TLT is what you're after and you're looking for whatever at 80, don't go up thinking, hey, it's not going to go. It pivoted right here at 100. It pivoted again here at 101. It's not going to go below 99. It might not, but don't do that. Sell at the strike price that you are happy to buy it. Think about it this way. Selling cash secured put options on stocks you would like to own at a strike price that you'd be comfortable to buy it at. If you sell at a strike price that you are not comfortable to buy it at, sooner or later you're gonna be a little stressed out. Depending on how well you deal with stress, you're gonna be a little stressed out or a lot. I don't know. Just don't put yourself in that position. This should be a sleep well at night trade. Do some other trades if you want to be a little riskier, or do whatever you want. Again, this is not financial advice. You take it for what it's worth. Be an adult. If you're under 18, physically or emotionally and mentally, you shouldn't be doing this stuff. You need to be an adult physically and emotionally, mentally, spiritually, whatever. All around, you need to be mature and accountable, and you need to realize Brent is not your financial advisor. and you got to do what you got to do. So practice the stuff, paper trade it, and with that, there's a little something good buddy Brent is doing. And about what time is it? Almost 8. And about 45 minutes or so. Got to go do something. You guys have a fantastic weekend. Aloha.